What the heck is going on in the residential solar space? Well, Tuesday night, Enphase Energy reported a complete horror show of a quarter. I mean, yet its stock still soared nearly 17% the next day. It's kept running all week, including another almost 5% gain today. So how do you justify this seemingly insane move? I'm sure you're asking yourself this because you've seen this stock. All right, let me set the scene. For me, Enphase is emblematic of the whole alleged solar industry. They got their start selling microinverters, which transform solar energy into usable electricity. Over time, Enphase got into installing entire home and solar systems. And, they did the whole shooting match. They've now moved into battery storage equipment, electric vehicle charging systems, too. Unlike so many other competitors, these guys actually run a profitable enterprise. And I've long said that Enterprise is among the best operators in the industry. But, and this is a very big but, this industry has been awful. This stock particularly got obliterated last year after a string of weak quarters as Wall Street turned against the entire group. While all things alternative energy got a big boost from the subsidies in that so-called Inflation Reduction Act, it wasn't enough to offset the damage from the Federal Reserve's relentless rate hikes. See, last year we found out that the whole residential solar business is powered by what we call financing. Almost nobody buys for the whole setup up front. Too expensive. And that means solar sales evaporate when the cost of financing soars. Hence why Enphase was the worst performer in the S&P 500 for 2023. It was down more than 50%. What was a great business in a zero interest rate environment became a trouble business when the Fed hit us with 525 basis points of rate hikes. Enphase didn't do anything particularly wrong. We just realized that the industry has far more interest rate risk than anybody thought, and it made solar products unaffordable. Fortunately, long-term interest rates peaked in October and have since pulled back substantially, while the Fed seems willing to cut short-term rates later this year. Although not as soon as the bulls were opening. And that's why Enphase saw its stock rebound from $73 at the early November lows, right when the Fed pivoted, to 140 at its peak in late December. In fact, this thing jumped 24% in 3 days after the Fed indicated the rate hikes were over. And its mid-December meeting, it was really clear then that this really was not a solar play, right? It was an interest rate play. Since then, loan rates have rebounded off their lows, and by earlier this week, Enphase was once again a $100 stock. Which brings me to the numbers that Enphase reported on Tuesday night. Numbers that allowed its shares to rebound back to 122 as of today after it rallied another 4.8%. Funny thing is, in absolute terms, Enphase reported an awful quarter. Revenues were down 58% year over year, and even down 45% just from the previous quarter. Earnings per share down 64% year over year, and a 47% from the prior quarter. They even had a 1 cent shortfall of a 55-cent basis. Despite its hideous downturn over the past 15-odd months, though, Enphase occasionally managed to put together a decent set of quarterly results. But it never mattered to the stock because the guidance was always hidden. And guess what? It was hideous again. Yeah, this time, while they're forecasting $260 to $300 million in sales for the current quarter, everybody was looking for $318 million. That's a bad guide down. So how in the world did this stock rally more than 17% the very next day off those terrible numbers? Did Wall Street lose its mind? No. In fact, this is a classic sign that their business is bottoming. CEO Badri Kothandaraman first hinted at the bottom when he was discussing Enphase's guidance, explaining that their first quarter sales forecast was so light, in part because they planned to undership. That's the key word. Undership product to their dealers. This is actually something the company's been doing for a few quarters in order to push back against the solar supply glut that happened when rates went up. And they plan to undership in the second quarter, too, but not by as much. More important, Kothandaraman said he expects, and I'm going to quote this is really the most important thing that happened, the channel to be normalized by the end of Q2. Now, later in the call, he got even more explicit, saying, quote, we think Q1 could be the bottom quarter, end quote. He went on to lay out that Europe's ahead of the United States, already showing, quote, showing early signs of recovery, end quote. And Enphase expects America to follow suit, with the exception of California, where regulatory changes enacted last spring pulled forward a big chunk of demand. California is the largest residential solar market in the country, so it is a problem. But even there, Enphase expects to start seeing sequentially higher revenue numbers by June. Once the question and answer session got rolling, Kothandaraman went into much more detail on the solar supply glut that I've been talking about and how things should start looking much better as we get closer to the second quarter. That's what the strategic undershipments are all about. The plan is for Enphase to undership by about $150 million worth of product versus the end customer demand until demand starts turning around. By the second quarter, Koth & Darman says they'll have taken $277 million worth of solar equipment out of the channel. And he expects, quote, the sell-through numbers to be seasonally better as you approach Q2, end quote. His optimistic commentary about the business beginning to bottom was enough to transform Enphase's terrible quarter into a positive catalyst. In fact, this was the first quarter that acted as a positive catalyst for the stock since October of 2022. Ultimately, Enphase sure looks like yet another, and there's another key word besides undership, destocking story. Meaning the company saw channel inventories build up last year, and they had to burn through that excess product. I've been talking a lot to you about destocking. It's something you see in every sector when you have a glut. Semiconductor cycle, especially with the commodity chip makers like Micron. That had terrible situation that got destocked. It's something we saw in the life science tools industry, where Danaher and Thermo Fisher have finally worked through their excess inventory and come out in much better places. That's one of the reasons why my trust owns Danaher and why I'm telling club members it's not too late to start buying right now. And as I tell you every time with these destocking stories, there's a pattern to how their stocks tend to trade. If you want to capture the gains from the bottom, you need to wade in to own the stocking question before the destocking ends and the business returns to growth mode. You can't wait for the turnaround to arrive, people. And even if it is painful,
the house of pain,
you need to buy ahead of time, or else you will miss the biggest gains. With Enphase, the stock already caught fire this week, but we're 3 to 6 months out from the moments where the numbers start genuinely improving, which means it's not too late for you to buy Enphase. One caveat here, which is that Enphase is only worth owning if you believe interest rates will fall over the course of the year. I think that's a safe bet, but it's a bet. Here's the bottom line. Enphase, listen to me. Enphase could rally like crazy after a horrific quarter because we're finally seeing the signs of an impending bottom that you and I have been waiting for, and because the solar stocks are much more attractive as we head into a lower interest rate world. So you do have my blessing to put a position here, then try to stab up some more next time when we get a market-wide sell-off. Yep, one of the most popular stocks among the Gen X, Gen Y, or whatever is back, and it might be almost as big as ever. William in Pennsylvania. William.
Hey, how you doing, Jim?
Oh, I'm doing good, William. How about you?
Very well, sir. Thank you. And thank you for taking my call.
Oh, you're welcome.
The reason I'm calling is we've owned PP&L stock for over 50 years, and it's kind of floundering. But yet I'm watching Constellation Energy, CEG, and they're doing very well. What are your thoughts on CEG taking over PP&L?
Oh, I like CEG so much, and we've liked it for a long time. Constellation Energy is all sorts of alternative energies. It is a terrific company with fantastic management. That's the one I would pull the trigger on right now, even though it is high. Hey, how about Gene in Louisiana? Gene.
Yes, booyah, Jim. My name is Gene, and I live in a great state of Louisiana.
Mm-hmm.
Jim,
my daughter went to Tulane, so I know it well.
Yeah, we got Mardi Gras here Tuesday. Jim, I have a portion in Delta Airlines. Do you think it's a hold, a sell?
No, I think Delta Airlines is the class of the field. I like it. I do think that airlines have not been great investable situations, but Delta at 40 seems like a buy to me. But I will tell you, if it gets to 60, I would indeed take the trade, and thank you for calling. Enphase could still rally like crazy after a horrific quarter. That's right. That's why I'm giving you my blessing to put on a small position here and try to snap up some more as it goes down. Much more Mad Money, including my Susan Blue, oh boy, red hot Cloudflare. After a strong quarter and rosy outlook, I'm talking to the net about how the company is putting its best foot forward to start the year. Then, the GLP-1 strike again? I mean, this time with PepsiCo in the crossfire? I'm detailing how I think this theme could continue to play out, and it's not all GLP-1. And of course, all your calls, rapid fire. Tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.